All right, good afternoon, everybody. And I know that a lot of you are probably pretty hungry, and we've got 21 minutes in front of me, and we will keep this power-packed, quick, and succinct. So let me just quickly set a little bit of a context. This is not going to be a 101 education of what the Unified Pension Scheme is. We're going to take it a little bit further, but I just want to spend 2 or 3 minutes giving you a bit of context, so then you know what Chitra and I are going to have a little bit of a fireside chat about, okay? So quick context. The government of India spent roughly $22.5 billion on pension disbursements in its financials. We have roughly 10 million central government, that's CG, and SG, that's state government employees that are members of the national pension scheme that they all are entitled to as employees of our great country. However, the national pension scheme was introduced about 14 to 15 years ago, and there has been a lot of clamoring over the last several years from the employees that it is not quite cutting the mustard. And therefore, a big drive has been there to go back to what was the old traditional old pension scheme in the country for those government employees. So, on the 24th of August 2024, the Unified Pension Scheme was announced. What is it? At the most highest level, it is a defined benefit scheme. It is a hybrid scheme. It's a target benefit scheme. It's a defined contribution scheme. And it's all of them, all try to be rolled up in one. And I'll explain very briefly about that a little bit in a minute. The big difference is, and this is what the government and the cabinet ministers have been talking about as what they feel a big value add, and there's many more that we'll speak to Chitra about, but the difference being the old pension scheme was directly paid from tax revenues. The Unified Pension Scheme is going to be setting up its own pre-funding, much like many occupational pension schemes around the world. However, it is not alone in reforming its pension scheme for government employees. There are several countries that have already been down this path in terms of pre-funding for government pensions. So, the first layer of what I'm going to try and explain to you is the Unified Pension Scheme. The first thing is on the government side. They are promising a defined benefit scheme to all of their employees. So there's some value there that they're actually offering. Their risk and how they're funding for it is twofold. The first is they are saying that they will put 10% from the government side and 10% from the employee side into a notional accounting benchmark balance. And to top up that benchmark balance, they will put another 8.5% of real money into a pooled corpus. The government's exposure is that that notional balance of the benchmark plus the pooled corpus is going to be able to be sufficient to meet all the defined benefit promises in the future of all the millions and millions of employees going forward. From an employee standpoint, the 10 plus 10 is actually invested, and they will have flexibility on how they try and invest that, subject to some restrictions, and that's real money in the hand of the employee. Where the employee risk sharing comes in is that if that 10 plus 10 does not equate to the benchmark corpus, notional accounting value benchmark the government is tracking, then the employee has to do a top-up and find money to top that up somewhere. And if their own pot is more than that notional balance of the government tracking, then they get the balance, the difference. They receive the difference. As if that wasn't complicated enough, when they first start joining the Unified Pension Scheme from 1st of April, all in new employees from the 1st of April 2025, they have a choice to make that they could actually join the national pension scheme. And if they join the national pension scheme, they get 14% from the government and 10% from their side. Okay? So I'm not going to go through any more details from that, but that just gives you a little bit of, hopefully, some overall picture of the architecture of what the unified pension scheme is. And in that context, one of the big changes, and Chitra here, uniquely an actuary, consulting actuary, and is also the chair of the National Pension Scheme Trust. And so what I wanted to ask you, Chitra, actually, is that, look, the NPS Trust was formed to look after and govern the National Pension Scheme, not only for the government employees, but the whole country. In the unified pension scheme for the government employees being of a different nature, I understand that the draft regulations have expanded the role of the National Pension Scheme Trust. Could you just shed a little bit of light on that expansion of the role and how it's kind of evolving from what you've been doing up until now only in the National Pension Scheme?
Thank you, Kulin. I think Kulin put in very put it very nicely as to what the unified pension scheme is. So before I actually go into the current role of the trust and what the future role would be, I probably would take a bit of time to speak about the history of the NPS. The NPS has, it's 2 decades since the NPS has been introduced.
20 years.
20 years, yes. So it was introduced in the first Jan 2004 for central and state government employees, except the armed forces. And in 2009, it was introduced to the all citizens. So 15 years for the other than central and state government employees, and for all citizens, it is 15 years. So the NPS has its own ecosystem. It's very unique, and it's an unbundled architecture, such that each of there are several intermediaries, and all of these intermediaries has a specific role to play, and it's very risk-free. That means that each of the intermediaries are not connected with each other, and also a structure such that it's there's no risk to it. Quickly touching upon the intermediaries, we have the NPS Trust, where I'm the chairperson. The NPS Trust manages they are the owner of the assets. They own the assets on behalf of the subscribers, and these assets are purchased by the pension fund managers on behalf of the NPS Trust. We have the central record keeping agency who holds all the data. So actually in the DPDP Act, which the government is going to introduce, the CRA plays a very major role. So they kind of hold the records, they do administrative and customer service activities. We have the pension fund managers, there are around 11 of them. They invest these funds according to the mandate which is floated by the PFRDA. We also have the trustee bank who actually perform the banking operations. We have one trustee bank, which is the Axis Bank. We have something called the custodian. They hold the demat accounts of all the assets. They are the Deutsche Bank. And we have the annuity service providers. Because the current NPS structure is 60%, up to 60% you can withdraw as a lump sum, and 40% you have to purchase annuity. So we have the annuity service providers as the ecosystem. Before I go into the role of the trust, quickly I'll touch upon the AUM growth, which is phenomenal. Currently, I think the speaker, the person who introduced, mentioned that we have around 13.4 lakh crores or 13.4 trillion assets under management as of today. And since the last decade, there has been a CAGR of 32.5% from 2014, which was 80,000 crores today, 13.4 trillion, which is phenomenal. And in this, the state government has a share of 51% and the central government has a share of 28%. So total share of 79%, which the unified pension scheme, there's a probability that. With respect to subscribers, again, we have around 19.6 million subscribers. And there is a CAGR of around 8.5% in the last decades. The state government and central government form around 50% of these subscribers. The performance of NPS has been phenomenal, especially in the equity space, it's been around 12%. So in the corporate sector, the performance in the last decade has been around 10 to 11%, which is really good. In case of central government and state government, it's been around 8 to 9%, which is again good, given that the weight is towards the corporate bonds. So let me go to your question, which you have spoken about. So the current roles and responsibilities of the NPS still remains because the NPS is still a part of the ecosystem, and there'll be additional responsibilities with respect to the UPS. See, currently the NPS is the registered owner of all the assets, and these assets are purchased by the pension fund managers. And these securities are held on behalf of these subscribers who are the actual owners. The NPS also monitors the investment activities of the pension fund managers. They ensure that the pension fund managers invest in a manner which is prescribed by the PFRD, the regulator, the pension regulator. The NPS monitors whether, and they also monitor the returns. They review the returns earned by the 11 pension fund managers, because end of the day, it's the subscribers' money which the pension fund managers manage. So the trust ensures that all these pension fund managers invest in a specific, they don't breach the benchmarks. So that's one of the main activities. The other two activities are with respect to exits and withdrawals, which is also the responsibility of the trust, and also with respect to grievance redressals. Of course, there's the auditing aspects which come with respect to the quarterly annual audits and all those aspects. The additional role which comes with respect to the implementation of the UPS. Until now, if you notice, it's the supervisory role which the trust has been playing. But now there's an administrative role also which the trust will be playing, which is quite huge.
You're really getting your hands dirty now.
Exactly. The responsibility of the trust is going to be really enhanced. First and foremost is the verification of the payout order which the central government is going to issue with respect to the benefit payout for those subscribers or central government employees who are going to opt for the UPS, which I think is going to be quite substantial. And also this pension, UPS, is DA linked, index linked. So there's also a dearness allowance which is attached to it, which is similar to the current pension scheme available to the central government employees. So those regular DA increases has to be released, has to be ensured that be provided to the central record keeping agency by the trust, which is an additional rule. And also the life certificates, which is a be-all and end-all of any pension, a person who is receiving pension. We know that we have to provide something called the life certificates to ensure that he is alive, right? So that is the verification of those is a trust responsibility now. And also if a UPS subscriber passes away, there's a amount which is needed to be released to the legally wedded spouse. I'm going to use the term legally. That has to be authorized by the
So we're
trust.
very much going from a supervisory role all these last 20 years to now actually having to get much more administrative. So it's a big role and a big thing for you to be involved in all of that.
Yeah.
I'm conscious of time.
Yes.
So what I'm going to do is just get down to pretty much, I think, would be the last question, the second question and the last question. So given that people have seen the graph that I did, and we bring it to a bit of an actuarial slant now and change flavor a little bit, is where do you now see, from your perspective as an actuary as well as the chair of the NPS Trust, areas where the unified pension scheme has elements to it that may well have this sustainability and financial sustainability point nailed, and which are the bits that you think there's still sort of stuff to uncover and things which might still be a bit risky and that we'll have to manage something going forward, and the role of actuaries that we can play in helping in that?
So you did mention that it is a combination of a defined benefit as well as a defined contribution. So as an actuary, we always a risk covers whenever there's a guarantee, right? So the non-sustainable part is the guarantee part. So you did mention when you were speaking about the UPS that there is a guarantee of 50% of average basic pay over the last 12 months. That is the guarantee which an employee gets when he opts for the unified pension scheme at the time of retirement. And there is a dearness allowance, the index link, which is also going to be provided. That's a guarantee. And there's a 60% guarantee to the spouse on the demise of the subscriber. And also for those employees who are retiring within 10 years, they also get an amount of some minimum pension, plus a lump sum at the time of retirement. So these are the guarantees. And as an actuary, there's a huge risk element when these guarantees are provided. But having said this, but there is some kind of sustainable part as well, which is not present in the current OPS or the old pension scheme. This is funded. Like you mentioned, there's a 28.5% fund, 10 plus 10, 20 in the subscriber account and 8.5% in what we call the pool account. All these are going to be invested in a prescribed investment format, and the returns are going to be available, for the future payouts is what I would say. So I think because it's funded, you always have some kind of fund available to make the payouts, assuming that this is sufficient going forward in the future. And there's one more big difference between the old pension scheme and the current pension scheme. In the earlier system, there used to be an early retirement, but in this, the pension is paid only at the time of, even in case of early retirement, it's paid only at the time of superannuation. For example, let's say a person who is 20 and 25 and he wants to retire at 40, but he opts for this UPS. He still gets a pension only when he is 60 years. So he needs to take a decision whether he needs to opt for UPS and stay until the retirement. I think this is a big game changer. Of course, there are some there's some issues where there's no clarity yet. With respect to death in service, there's no kind of mandate around that. And also for unmarried members, because it is available, the only spousal benefits are legally wedded spousal benefits are available. There's no mandate on for the unmarried members where the pension will go.
And we've still got a few minutes to go before I open up for any questions from the audience. One final question. So you were trying to explain, these different features of sustainability and those that still need to be uncovered. Now, at the end of the day, the employees are going to have to make a choice, like I said. If I'm part of the UPS, along my journey of being an employee, how much chance is there of my pot being able to meet the benchmark? And secondly, even when I join, I have to decide UPS or NPS.
Right.
And NPS is slightly different, and you get 4% more in that for yourself. And so where do you think the role of the actuary and opportunity for us exists as a community to support not only the employees, but also the government in its long-term sustainability goal of UPS?
Since it's a funded scheme, and there is a guarantee element to it, there's always a gap with respect to how much fund is required to be available in the pool. So the payouts are going to make from the pool corpus, right? So when the employee retires, superannuates, his portion of 10 plus 10, 20% is going to be transferred to the pool corpus. And all the assured payouts is going to be made from the pool corpus. Now, as an actuary, I think the regulations do specify that an actuarial valuation needs to be done year on year to determine the gap. So I think the government feels that in future, maybe there'll be an initial funding which is going to be done by the government, and over a period of time, there'd be no need for funding, because this should be the investment pattern, and the interest which the fund is earning should be sufficient to take care of the future payouts. So this is very good compared to the OPS where there's no funding at all, compared to this where there is this funding and plus the appropriate investment returns should take care of the future payouts.
Yeah, and I know for a fact that there are some actuarial actuaries at the government and the PFRDA. They've been working on the design and educating the government on all of this. And I also know that if I'm going to get my conversions correct, I think that the government in its 25-26 budget has provisioned something around $750 million equivalent for all of this to sort of set the ball rolling. So 2 minutes, 52 seconds. I open up the floor for any one question before I can all let you go and have your lunch. Any questions? Put your hands up and I can make sure the mic gets to you.
Question, guys?
We're around over lunch or over tea or anything like that. I know everyone's gagging for some food. Oh, there's a hand up there. There's a hand up.
So maybe we are standing between the lunch and then.
Hi Kulin, hi Chitra. And it will be an easy question probably. You noted the UPS is going to be specifically open for state government and central government employees as of now.
Someone help with repeating that question. The audio is not coming
Can you hear me? Is it better?
Yeah, that's a bit better.
Okay, so I was saying the UPS is supposed to be open for central and state government employees for now. Is that correct?
No, it's not.
At the moment, it's central government employees only.
Okay.
The word that is on the street is that there are one or two states that have clearly been open about their intention to then
I think
adopt.
the Maharashtra,
Maharashtra
government has
itself,
passed the,
we're in Maharashtra today, they are very clearly indicated their intent to follow suit. But then we have many other states that will no doubt contemplate the decision.
Yeah, so yeah, that's right. The Maharashtra, I think cabinet has passed regulation to adopt the UPS. But many of the states are contemplating implementing, moving from NPS to UPS. But it's not going to be in the same form as what we saw with respect to the UPS. They're going to come in different forms. So maybe they not have 50% of the loss drawn, they may have like 45%. It's all depending on how much fund they can implement. Everything is going to be a different fund. It's not going to be a common pool fund. They're not going to combine the fund with the central government. So every state probably will have different funds, and also they'll have different features of their own, the UPS. So
Okay.
the flexibility is going to be quite high.
Okay, and the direction I was actually headed is, like for example, NPS opened up for government employees, and then it was open to the entire public. I know it's still too early to maybe think about that, and I know Kulin is laughing about that, but do we anticipate this to be happening for private sector as well?
I don't think so, because private sector, I think, it's not towards the defined benefit pension. So this, if you notice, it's only for those employees, or I say who already have OPS in their system. So private sector never had OPS, or they did not have any kind of defined benefit pension with them. So I doubt, but you never know.
But something would be lovely.
We never know.
You never know, but looking at the whole global trend and everything with occupational pension schemes, to be able to then say that I'm going to take again another punt and put big numbers on my balance sheets, I think the large companies and small companies all across the world might have something to say about that. But you never know, because there may be an equilibrium somewhere along the way.
Yep. Thank you so much.
Thank you.